Hey, good morning, everyone. I'll be explaining how to do the adjustments for your income statement and balance sheet question, which is a compulsory question in your examinations. Okay, so let's take a look at our first transaction. Our first transaction says that the net realizable value of the inventory as at 31st March 2017 was $38,500. This means that the ending value of my inventory, okay, is actually $38,500. But let's see what is the cost that is recorded by the business. Okay, the cost that's recorded by the business is $39,000. Okay, but the net realizable value is $38,500. Okay, this means that there's actually a loss in the value of inventory. Okay, and this loss in the value of inventory is known as my impairment loss. So let's see how much is our loss. The drop in value of my inventory is $500, correct? To get to $38,500. Okay, and this $500 is my impairment loss on inventory. Okay, we have $500. Okay, the first adjustment is done. Let's look at our second adjustment. Okay, a sales invoice of $3,500 was omitted. The correct entry was made in the cost of sales account. Okay, first thing, okay, we got to ask ourselves, what is the meaning of the word invoice? Okay, the word invoice means that there's still an amount owing by the customer, okay, because this is a sales invoice, so amount owing by customer. So what happens is that the business actually sold goods to the customer for $3,500. This is my selling price. Okay, and they did not record it down. Okay, the word omitted means that they did not record it down. Hence, what do we need to do to adjust for this? We need to debit trade receivables, credit sales revenue. 3,500. By right, when we sell goods, we should also record the cost price. Okay, in this case, the cost price is recorded as debit cost of sales, credit inventory. However, the question said that the correct entry was made in the cost of sales account, which means that the business has already recorded this transaction. Okay, they have recorded this transaction down. Hence, we do not need to adjust for this transaction debit cost of sales, credit inventory anymore. But we do need to adjust for trade receivables and sales revenue. So let's go up and adjust our value. Okay, my trade receivables, okay, should go up by $3,500. Okay, and my sales revenue, let's see, where's our sales revenue? Sales revenue, yes, it's up there. Okay, should go up by $3,500. Let's look at the third adjustment. Okay, third adjustment says that a debt owed by credit customer Linda of $750 was to be written off as irrecoverable. Okay, so what does this mean? The word irrecoverable means that the debt is confirmed uncollectible. So we need to do something called a write-off. Okay, and how do we write off the debt? Our journal entry is actually debit allowance, okay, for impairment of trade receivables, okay, credit trade receivables, Linda. Okay, so the amount is actually $750. Let's go up and do our adjustment. When we write off the allowance amount, okay, the allowance amount actually goes down. So we should minus, how much is the amount that's written off? We should minus $750. Okay, and my trade receivables, I should minus $750 because these are the debts that are written off. Let's look at the fourth adjustment. A review of trade receivables showed that the debt amounting to $1,000 might be uncollectible. Okay, so what does this tell us? The word might be uncollectible, okay, tells us that the ending balance, let me change the color first. Okay, it tells us that the ending balance for the account allowance for impairment of trade receivables, okay, is equals to $1,000. Okay, which means that I want my ending balance for my allowance account, okay, to reflect a value of $1,000 because this is the amount that might be uncollectible. Before we do our adjustments, okay, let's look at the updated balance in my allowance account first. Okay, let's see how much do we have in our allowance account. After I've written off, okay, so remember this $750, right? This is the amount that was written off. After I write off, I am left with $150. So this is the amount. I'm left with $150. Okay, but I want my ending balance to be $1,000. Okay, this is given in the question. I want my ending balance to be $1,000. But the updated balance now is only $150. So we have to ask ourselves, how do I increase my impairment loss such that, or how can I increase my allowance such that I can get a value of $1,000? Okay, so the difference would actually be, I have to add, okay, and how much do I have to add? $850. Okay, so because my allowance went up, let's write down the adjustments first. If you recall from what you are taught, okay, my allowance actually went up. Allowance for impairment of trade receivables. Okay, it went up by $850. Correct? This is what we have recorded just now to reflect the increase in my allowance. Hence, I would have to debit a loss, which is known as my impairment loss on TR, $850. Okay, so we have to create another account called impairment loss on trade receivables. Let's write down here. Okay, $850. And to remind yourself, right, it would be good if you can write down here that my impairment loss on trade receivables, this is a expense. Okay, and my allowance for impairment of trade receivables, this is a contra asset. Okay, let's move on to the next adjustment.